The power flip of 2026. Bitcoin miners now control more high-density power capacity for artificial intelligence than for mining blocks. Over the last 30 days, 3 of the largest publicly traded mining firms have officially reclassified over 50% of their energized pipeline as high-performance computing facilities rather than crypto mines. This shift is not a pivot in sentiment but a cold calculation of hardware efficiency and energy arbitrage. The market is no longer valuing these companies on their ability to solve SHA-256 hashes, but on their ability to host H300 clusters. This transition has triggered an 85% rally across the sector, driven by a desperate search for power in an AI-saturated world. This massive reallocation of energy changes the definition of what a miner actually is, moving from a lottery participant to a critical infrastructure provider, the compute-to-hash ratio. Wall Street analysts have discarded the old cost to mine 1 Bitcoin metric in favor of the compute-to-hash ratio. This engineering metric measures a firm's total power capacity allocated to GPU workloads versus its remaining ASIC hash rate. Because a kilowatt-hour utilized for AI inference currently generates 4 times the revenue of a kilowatt-hour used for Bitcoin mining, the ratio has become the primary signal for institutional capital. Firms like Core Scientific and IREN are stripping out old air-cooled mining rigs to make room for liquid-cooled server racks. The design trade-off is clear. While Bitcoin mining is interruptible and flexible, AI workloads require Tier 3 data center specifications, including redundant power feeds and massive cooling upgrades. This physical transformation of the job site reveals the end of the hobbyist era for industrial miners. This infrastructure upgrade cycle creates a massive capital expenditure hurdle that only the largest players can clear. The hyperscaler land grab. Tech giants are no longer building their own data centers from scratch. They are cannibalizing the Bitcoin mining industry for its power permits and grid connections. In the last month alone, Amazon and Microsoft have signed 3 multi-gigawatt power purchase agreements with former mining sites. These hyperscalers are paying a premium for speed to market, because the wait time for new utility-scale transformers has reached a 4-year lead time. For a miner, the decision is simple: continue competing in a global arms race with thinning margins, or lease their energized land to a trillion-dollar tech company for a guaranteed fixed fee. This has turned mining stocks into real estate plays backed by energy contracts. However, the risk lies in the specific power density requirements. Not every mining shed can be converted to an AI hub, and the market is currently struggling to differentiate between high-spec facilities and glorified metal boxes with fans. The ASIC obsolescence trap. While GPU hosting is the current focus, the secondary market for used Bitcoin mining hardware has effectively collapsed. As miners migrate their power to AI, millions of terahashes are being forced off the network, leading to the largest downward difficulty adjustment in the post-halving era. This creates a divergence between the stock price of the company and the health of the underlying network it once secured. If a firm moves 60% of its power to AI, it is effectively retiring its fleet of ASICs years before their scheduled depreciation. This leaves a massive hole in the balance sheet that must be filled by the higher margins of compute leasing. For the Bitcoin network, this migration means hash rate is becoming more concentrated in regions with the lowest power costs where AI demand has not yet arrived. The hardware pivot is essentially a massive bet that the AI demand curve will remain vertical long enough to pay off the debt used to build these new facilities. The real implication. The AI-Hashrate Singularity proves that Bitcoin mining has evolved from a niche cryptographic experiment into a global energy balancing act. The 85% rally in these stocks is not a bet on the price of a token, but a realization that the compute-to-hash ratio represents the most efficient way to price industrial electricity in 2026. Because firms are prioritizing GPU workloads over SHA-256 hashes, we are seeing a permanent decoupling of mining company valuations from the Bitcoin price itself. For the industry, this means the era of the pure-play miner is ending, replaced by a hybrid model where crypto mining serves as a bottom-floor revenue stream used only when AI demand fluctuates. The strategic shift toward Tier 3 data center specifications suggests that power is the only true currency in the digital age. Watch the upcoming quarterly filings for the capital expenditure shift toward liquid cooling infrastructure. This metric will be the definitive indicator of which companies are successfully making the leap to infrastructure providers and which are simply holding on to depreciating silicon. Subscribe for more